Apple, Google, Amazon. These companies sell to the entire world. But here's something most people never stop to question. Why are they based in those countries and not others? Because it's not random, and it's definitely not about flags or culture. It's about money. And once you see the pattern, you'll never look at global companies the same way again. Let's start with a simple idea. Big companies love to say they're global, but in reality, every global company makes very local decisions. Where to register, where to pay taxes, where to hire, where to ship from. Each of those choices quietly decides how much money they keep and how fast they grow. So when you see a company choose one country over another, it's usually because that country gives them a financial edge. Let's break that edge down. First, taxes, but not the way you think. Most people assume companies only care about low taxes. That's not entirely true. What companies really want is predictable taxes. A country with slightly higher taxes but stable rules is often better than a country with very low taxes that can change overnight. Why? Because uncertainty is expensive. If a government suddenly changes tax laws, companies can lose billions instantly. Investors panic. Stock prices fall. Long-term planning becomes impossible. That's why many big tech companies choose places like Ireland or Singapore. Not because taxes are magically zero, but because the rules are clear, consistent, and long-term. In business, clarity beats generosity. Second, geography quietly turns into speed. Here's a rule most people don't hear often. Speed is money. The closer a company is to its customers, suppliers, or shipping routes, the faster it moves, and the cheaper it operates. This is why so many global companies cluster near major ports, busy shipping lanes, central time zones. For example, companies that sell to Europe, Africa, and the Middle East often choose countries that sit right in the middle. Why? Because shipping something from a central location can cost less and arrive faster than shipping from the edge of the map. Even time zones matter. If your headquarters and your markets share similar working hours, decisions happen faster. Meetings don't get delayed. Problems get solved the same day. Multiply that efficiency over years, and geography quietly becomes profit. Third, companies follow talent, not just markets. People often think companies create talent. In reality, companies follow talent. Engineers, finance experts, designers, and manufacturers don't spread evenly across the world. They cluster. And once a cluster forms, companies rush in. That's why tech companies gather in certain cities. Finance firms crowd into specific hubs. Manufacturing stays close to skilled labor zones. When a country invests heavily in education, training, and skills, it becomes a magnet. And once the first few big companies arrive, others follow, because hiring becomes easier, faster, and cheaper. Talent reduces risk, and big companies hate risk. Fourth, stability matters more than perfection. Here's something that surprises many people. Companies don't need a country to be perfect. They just need it to be stable. Stable laws. Stable courts, stable enforcement. A company signing a 20-year contract wants to know that contract will still mean something in 20 years. That's why companies avoid countries where rules change suddenly, laws aren't enforced consistently, political decisions feel unpredictable. Even if operating costs are low, instability scares investors. So companies often choose countries that feel boring. And in business, boring is powerful. Now let's make this real. Take Ireland. Why do so many global tech companies operate there? It's not because Ireland has the biggest population. It's not because it's the cheapest place on earth. It's because Ireland offers clear tax structures, access to the European market, a skilled, English-speaking workforce, long-term regulatory consistency. From a financial perspective, it's efficient, and efficiency compounds. Here's the bigger pattern most people miss. Countries are not just places on a map. They are business systems. Each country offers a different mix of rules, geography, talent, stability. Companies simply choose the system that lets them grow with the least friction. That's why you see clusters. It's not coincidence. It's optimization. And this explains something even bigger. When companies move factories, offices, or headquarters, they're not abandoning countries emotionally. They're responding financially. Money flows where systems make sense. And countries that understand this don't compete with slogans, they compete with structure. So what does this mean for you? It means global business isn't chaotic. It's patterned. Once you understand why companies choose certain countries, you can start predicting where industries will grow, which countries will attract capital, where opportunities quietly form next. And that skill, seeing the pattern before it's obvious, is incredibly valuable. Because behind every big company on the map, there's a quiet financial reason it chose to be exactly where it is. And now you know how to spot it.